Lingering concerns over tighter monetary policies continue to hurt stocks, even as big earnings for the season kick off with TCS's numbers today. Autos and industrials bear the brunt, IT fares relatively better.
JLR reports weak sales for September on semiconductor shortage, even as demand for key models remains strong. Analysts see this delaying Tata Motors deleveraging.
The J. Prakash Associates board decides to divest its significant cement assets, while its arm JP Power Ventures will also divest its Nigri cement grinding unit. The deal will help lighten the group's debt.
IDBI Bank surges on government and LIC eyeing a 60% stake sale, while India Bulls Housing Finance sinks after the ED says it will challenge the High Court order. High Court stay on proceedings, and Bandhan Bank slips on a weak Q2 update.
Hello and welcome. You're watching us here on a fresh new edition of Halftime Report in a fresh new week. I'm Mangal Malu, with me Ekta Batra as well as Sonia Shenoy. Well, it's not looking as bad as it was at one point in today's trading session, because as we speak, yes, the Nifty is down about 120 odd points, but we've seen some recovery from the lows, and that's courtesy two big sectors. The Bank Nifty has recovered, it's just about 0.25% or by 100 points in the red right now. And the second one is the big recovery that we've seen in all the IT stocks. In fact, IT index is now firmly in the green, the only large index to be in the green. And it's important for that index to be in the green because from an earnings standpoint, it is an important week. We do have TCS, Infosys, Wipro, and all the IT majors reporting their earnings this week.
Oh, absolutely. From here on, it's going to be like, a complete avalanche of earnings, right, hitting us. So we have to just, I guess, prepare ourselves. But the number I'm watching out for is 16,980, which is the 200-day moving average on the index. We are holding well above that for now. It's still some distance off, but given the way things have been so far, I think, there is definitely pressure. And heading into the next few days, you have a lot of data coming out from the US as well. All eyes will now be on whether the Fed continues to toughen its stance, given that the jobs data was strong enough. So there's no reason to really, cool off on rates. They have to sort of get inflation under control. All of this put together may continue to get equities on the back foot. And I guess that's what our own markets are getting spooked with as well.
Well, absolutely, Sonia. You're watching that number on the Nifty, but the US CPI data, which is due on Thursday, will be the number that the street is watching, or maybe even the global markets are watching at this point in time. Yes, the US jobs data was strong, but whether or not there is any kind of softening in the US CPI data will determine what the Fed's trajectory would be going forward as well. But there are a lot of stocks in focus this morning. Let's get you some important stocks in news. Tata Motors is under pressure. This is after the second quarter. JLR sales have fallen this time round. Sonia, tell us more. The stock is down. It's recovered a bit from the day's low, but nonetheless, the data is disappointing.
These are very weak numbers. There's no other way to cut it, right? That's why the stock is the biggest Nifty loser today. The Q2 retail sales are under pressure. The management, of course, has said that this is because of supply side challenges. But given that a lot of its peers have seen a recovery in numbers, this comes as a bit of a disappointment. The Q2 retail numbers went down by 5% year on year. But if you look at the breakup, Jaguar sales are down almost 10% year on year, and Land Rover sales are down by about 3.6%. Now, if you look at the average, right, in Q2, about 88,000 units were sold. Now, this compares to 78,800 in the preceding quarter and 79,000. But there was a time in Q2 of FY22, for example, when they sold in excess of 92,000. The previous month, the previous quarter, there was 1.24 lakhs. So on an average, the improvement in Q2 looks like it's pretty good. But if you compare it to the history of JLR, they've on an average done 90,000 plus. And they're not getting back to that yet. I think that's the disappointment that the street has. JP Morgan, in fact, downgraded Tata Motors from an overweight to a neutral. They said that the delay in the deleveraging timeline is a disappointment, and there's a miss driven by supply chain constraints. The wholesales have disappointed quite a bit, while retails are slightly better than what was expected. And that's the reason the stock is under pressure.
All right, that is the stock which is under pressure. But let's talk about another stock which is actually surging in today's trading session. And this after the company's announced a preferential issue of warrants worth almost 115 odd crores. Sonia, we're talking about Atul Auto. What's going on out here? Big investors.
Absolutely. And that's where the interesting angle comes in, right? Veteran investor Vijay Kedia has invested 100 crores in Atul Auto. Now, the total warrants that were issued were 115 crores, out of which 100 crores was issued to Vijay Kedia. That's a total of 58 lakh warrants, out of which 50 lakhs gets allotted to Vijay Kedia, and his shareholding will increase to 18.2% in Atul Auto. Now, we all know Atul Auto is a three-wheeler manufacturing company based out of Gujarat. The company has had a very challenging last few years, but in the last couple of months, things have picked up. In fact, in this fiscal, the total sales, April to September, have gone up 80% year on year, and September sales itself have gone up 20%. So maybe Mr. Vijay Kedia is seeing a recovery in the three-wheeler cycle, and that's why this fresh investment has come through. But this is Vijay Kedia's re-entry into Atul Auto. Way back in 2005, he had invested at a price of 9 rupees. Since then, his investment went up 5,700% in 9 years. Then the stock, of course, fell off quite a bit. So this is his second investment in Atul Auto, and it's been a spectacular success. In fact, in his list of stocks, it has been one of the biggest multi-baggers. So now his reinvestment has raised a lot of eyebrows, and hence the stock is up 11%.
Okay, well, let's see if it's second time lucky or not. The first time, definitely. But let's focus on some stock-specific action. Then Jaiprakash Associates is surging. This is after the board has approved the divestment of their cement business. What does this mean? Nimesh joins in with the details on this story.
So it's not only JP Associates but JP Power as well. Even both the boards today have approved selling their non-core assets. So for JP Associates, the board has approved to sell the majority of the cement assets. Now, if you look at the annual report, they have a installed capacity of 10.5 million ton, according to the latest annual report for JP Associates. So that's the first information. The second is even the JP Power board has approved selling the grinding unit. Now, what I understand from sources, a large conglomerate is going to buy the entire assets of the JPA group in today's deal. So that's the word from the sources. Now, if you look at the proceeds of this cement assets will largely be used to pay the debt according to the press release as well. So if you look at the group debt for JP Associates, it's close to 28,000 crores, which includes both short-term as well as long-term debt, and majority of the money which they will receive from selling the cement assets will be used to pay the debt. Now, the most critical part for JP Associates is one, the shareholders won't benefit anything because most of the money from the asset sale will go to the lenders. But what is important is the SBI, which is a lead banker in JP Associates, they were almost pretty much close to tracking the company to NCLT. Now that the proceeds have come or will come, there is a very high likelihood that the lenders will not take JP Associates to NCLT. So that's a benefit as far as the JP Associates is concerned. For JP Power, it's a small grinding unit is what I understand, a small money that they will get by selling this particular asset. And again, that money will be used to pay the debt in JP Power Venture as well. So official announcement from both the group is they are looking to sell the large part of the cement assets as well as the non-core assets, and the proceeds will be largely been used to repay the debt.
Take that point, Nimesh. Thanks a lot for that. Cement has been the buzzword in terms of mergers and acquisitions over the last few months or so. We've seen a couple of deals being announced and fructified out there, a lot of capex too. But let's talk about Bandhan Bank. That's the stock under pressure in today's trading session. Week second quarter business update, Abhishek.
Well, to begin with, Bandhan Bank, nothing home to write about the loan movement that they have seen in H1, and they are also losing sheen on the retail deposits. So the book has remained flat for H1 FY23 when compared to FY22 numbers. Overall, the advances in Q2 FY23 have grown by 21.7% YOY and about 2.8% sequentially. There has not been significant improvement in collection efficiency, given the fact that collection efficiency was at 97% as of September, which compares to 99% that they had in the month of March. So CASA ratio has also declined. It is the low-cost deposit ratio declined by almost 240 basis points on a sequential basis, coming down to 40.8% when compared to 43.2% in the previous quarter. Even the retail deposit, they are losing sheen over there. It's declined by 520 basis points on a sequential basis to about 74.1% of the overall deposits when compared to 79.3% in the previous quarter. Back to you.
What about Paytm? How did the Q2 business look this time around?
Well, the ticket sizes might have increased as per my calculation. So the number of loans disbursed, that's up about 223% on a YY basis and about 8.5% sequentially. The value of loans disbursed, that's up almost 32% on a sequential basis. So if you take into these two numbers and calculate, the average ticket size in terms of disbursals is up about 80% YOY and about 21.5% sequentially. The gross merchandise value, that's up more than 62% YOY and about 7.5% sequentially. The average MTU, that is, is at 8 crore, up 40.4% YOY and about 6.7% sequentially. If you calculate GMV per MTU, it comes to about 39,750 rupees, which is up 15.6% YOY and about 0.7% sequentially. So the disbursements are seeing an uptick in terms of ticket sizes for Paytm in Q2 FY23. Back to you.
Okay. All right, Abhishek. Thanks very much for that. So that's on Paytm. We need to take a short break, but before we do that, here's some great news for investors. You can now track the US market action real time on Money Control. Log on to Money Control, the website or the app, and stay informed about all the matters in the global markets. Welcome back. Well, the bank Nifty has now inched into the green as we speak, or just about flattened out. So there has been an intraday recovery which has taken place for our markets. Whether it sustains, whether we build on that, let's see how the European markets open. That will also throw up some cues for us. But as of now, we do have a big cue to reckon with. Earnings season kicks off for Q2 FY23 today with TCS. Nimesh has collated key data points to tell us what we can expect from this earnings season. Nimesh, over to you.
It's going to be very, very hectic for the next 4 weeks for us as we look at the earnings season. And, look at the calendar for next week itself. It's going to be a hectic next week to start with TCS on October 10th. Then we have Delta on October 11th, HCL Tech and Wipro, both from IT on October 12th. We have Infosys and Mindtree on 13th. We have Bajaj Auto and Tata Elxsi on 14th. And even on a Saturday, it's going to be very hectic with Avenue Supermart, HDFC Bank, ICICI Pru Life and L&T Infotech all reporting on the 15th. So it's going to be quite hectic to start with the next week. Now, I've just looked at the overall earnings preview of a lot of the brokerages. So here's the summary of Q2. The potential leaders are going to come from BFSI, consumers and autos. They are expected to report strong numbers, whereas laggards is going to be from metals and oil and gas. They are going to disappoint. So I've looked at the individual sectors now. The first is technology, because they are going to start first. It's going to be a mixed bag for technology, but it's not going to have a big impact on the FY23 and FY24 EPS estimates. That's the overall consensus. The growth may slow down in FY24 estimates, but it appears to be price change. So there's not going to be a big scare. However, the risk is the recession, the deep recession in US and Europe. So that's for the IT sector. Now coming to the banks, because that's a big sector. Within the banking sector, I think the big theme is the credit growth and NIMs are showing resilience and liabilities are gaining focus. But the biggest surprise in terms of positive surprise will come in the private banks. The PAT growth, the analysts are expecting a 53% growth YOY. So that's on private banks. On NBFCs, the growth is picking up. So even there's going to be no big negative surprise. Even for housing finance companies, there's going to be a strong individual disbursement for the HFC. So that's going to be clean. And for the insurance companies, there's going to be some moderation in terms of the VNB margins compared to the Q1. So there's going to be a small disappointment on the insurance. Coming to the auto sector now, again, that's going to be a big sector and it's going to outperform. So sequentially, it's going to be an improvement in the margins. Q3 is going to be the best quarter in terms of recovery from the input cost, which was hitting them. So CLS has put out a note, and they believe that in Q2, the biggest EBITDA, highest EBITDA margins will come for Ashok Leyland and Maruti. So they too are going to outperform as far as the autos are concerned. Now coming to the cement sector, it's going to be a washout sector for cement in Q2, but that looks like it's in the price. So the profitability will be at a multi-quarter low in Q2 for most of the cement companies. In fact, Street is expecting the EBITDA per ton to fall by 50% YOY in Q2. Expect margins to recover only from Q3. But again, it looks like to some extent it's in the price. Now coming to the telecom sector, it looks like it's a stable quarter for telecom, limited surprises. 5G is going to be the next big trigger. For Bharti Airtel, it's going to be a slight increase in the ARPU. But for Vodafone India and Indus Tower, that's going to be a tepid quarter. So that's going to be for telecom. Now looking at the paint sector, that's going to again report a very strong quarter according to the brokerage. So demand is quite buoyant. There is a festive cheer as well. And Macquarie believes that Asian Paints is going to lead the paint sector. So that's with the paints preview. If you look at the fintech companies, now I picked up for a specific reason. It's going to be a steady quarter for fintech companies. Paytm across the board, there's going to be a good momentum. For PB Fintech, again, sustained growth. But for all these companies, the lock-in opens in November, and that's going to be a big overhang for all these stocks. So fintech largely on the lock-in overhang will be key to watch out. So as I said, it's going to be a mixed quarter for quarter two. No big surprises, but I guess individual sectors will be very important as far as reactions are concerned.
And we kickstart with IT later in the evening with TCS, and the stock is going in with some caution, definitely. Manoj Baheti, the founder at Carnelian Asset Advisors, joins us now to talk about that. Manoj, good afternoon. From a market standpoint, I wanted to understand from you, how important are these earnings in the context that, a lot of sectors in any case have been under pressure ahead of earnings, so expectations are not too high. But you tell us, how are you going into it?
Hi. Good afternoon, Sonia. Generally, we don't look at quarterly earnings that closely, as I mentioned to you. But if I look specifically for this quarter earning, I think banks and financials should do very well. I think there are three tailwinds for banks specifically. The credit growth is coming back. We can see NIM expansion because the interest rate on loans have started going up, and the interest rate on liabilities yet to catch up. That is number two, and credit cost for banks will continue to be benign. So these three tailwinds will continue to support banks for this quarter as well as for next 2-3 years. We see strong tailwinds for entire banking sector growth. And specifically in the banks, we continue to like private sector banks. Few of the PSU banks also should do well. And NBFCs are going to catch up. So this is our take on the banking sector. Secondly, coming to automobile sector, I think automobile sector is going to have good time after almost 2-3 years of lull. Commodity prices are coming to their favor. Commodity prices are correcting. The demand scenario is very, very robust. Most of the automobile players, especially PV side, they are having a very, very strong order book. And now with chip supply issues behind, we see that the supply side will also get sorted. So we expect a good EBITDA margin boost also for automobile players, and even auto ancillaries will do really well. This quarter, as well as I would say next 1-2 years, there is going to be good tailwind for automobile sector.
Right.
And yeah.
Right. Take that point, on banks as well as auto. Wanted to understand your thoughts on the IT space in particular, because that's the second largest weight on the index after the banking index. Yeah. And, the index the IT index itself has underperformed this year. It's down almost 30% as against the Nifty, which is just marginally negative. We have all the IT earnings coming this time around this week itself. Your thoughts on what is to be expected and how much can that move the needle for the market?
See, IT sector, if I look, definitely there are structural headwinds right now. And I would say not structural headwinds, it's a medium-term headwind because nobody knows that how the demand scenario in US and Europe is going to pan out. But talking about specifically about this quarter, I think IT sector should continue to report decent dollar-denominated growth. Their constant currency growth may take some beating because of the cross-currency headwinds. And margin pressure, I think this quarter should be the last in terms of margin pressures. Next quarter onward, we may start seeing margin pressure coming down because I think the attrition issue which the IT sector was facing almost for last 1 year, it is going to subside. So structurally, we are bullish on IT sector because the kind of digitization theme or the kind of cloud migration, all that is started, it will continue. But I would say that in terms of execution of the order book, it may happen that it may get delayed. So to that extent, the growth trajectory of few of the IT companies may get delayed. But in terms of long term, I would say the structural trend specifically for Indian IT companies remains intact.
Okay. The other factor which a lot of people will be watching closely is the sequential improvement in margins, which will be aided by raw materials or input costs softening. What is your sense in terms of how much margins could benefit, and in which sectors more specifically would you expect the most improvement?
Sure. In fact, I would say automobile is one of the sector which this quarter we may not see a full impact of the commodity price correction, but next quarter I would see that this impact will be much more visible. Consumer durable sector is one sector which one should watch. Even FMCG sector which were grappling with high commodity prices, like recently we have seen that HUL has even taken a cut in some of their products. And that is nothing but outcome of correction in the commodity prices. So I would say that these three sectors should benefit from correction in commodity prices.
Okay, and before we let you go, apart from earnings season, that of course is the topic of the moment, any other big themes that you like that stand out for you from an investment standpoint over the next, say, 6 to 12 months?
I would say I would change, instead of next 6 to 12 months, I would say for next 2 to 3 years, we are very, very bullish on entire manufacturing sector in India. Means the kind of reforms and the kind of global scenario which is favorable for India, China +1, along with the domestic reforms and PLI incentives which has been announced by government. So entire manufacturing sector, whether it is APIs, whether it is auto ancillaries, chemicals, so on the entire manufacturing space, we are very, very positive. And from long-term perspective, we are positive on IT and digitization theme also.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us your sense in terms of what we can expect from the earnings season. And, Manglam, we were having a chat with Poly Medicure, and he did mention that China +1 factor would be probably one of the big growth drivers for them going forward, something that Manoj mentioned as well. Time for a quick break, but up next, Sudeep Shah of SBI Securities will join in with some trading strategies and what he would strategize and recommend today. Stay tuned.
Welcome back. The Nifty is sitting with a cut of less than 100 points now. Has been a big recovery from the lows. But, as the Nifty has recovered from the lows, what hasn't happened is the volatility hasn't gone down. In fact, the India VIX has moved to the high point of trade with a gain of almost 4 to 5%. And that's telling you that, even at higher levels, the traders are kind of, nervous about the way the markets will move, given the volatility that we have. And as a result of it, even as the Nifty, which is above, 17,200 mark, we're seeing a fair amount of action at the 17,100 call and the 17,100 put. Now, if you would remember, Red, sorry.
Some issue with your mic. So what we're going to do is we're going to just try and get that back on board. It's hard to make you stop talking. So once in a while, when the mic, it's back. So. Okay.
It's hard to keep me not talking for a very long time.
Go ahead.
Okay, so I'll try to make this not Greek. There is fair amount of volatility that we're seeing in the market. 17,200 is where the Nifty is at right now. But, if you just take a look at the action in the options, it's the 17,100 call and put, which are extremely active. Option writers are basically positioning themselves for a wide range, 16,850 to 17,350, and that's basis the premiums that there are on both these options, the 17,100 call and put. But the interesting index is the Nifty Bank, which has bounced over 500 points, closer to 600 points from the lows of 38,500 hit today. And now it's above that 50-day moving average of 39,094. It protected the 50-day moving average on Friday as well. So let's see whether this sustains or not. Two stocks I'm watching out for in particular. The first one is Indiabulls Housing Finance. The stock is likely to enter F&O ban today. Why do I say that? Because October futures open interest has increased by 16% already. And as of Friday, it was 86%. So if it increases beyond 95%, the stock goes into F&O ban. And the second one I'm watching out for is TCS. Ahead of results, we have a lot of action at the 3,200 call and the 3,000 put. Remember, call writers are expecting 3,200 to not cross. 3,000 put writers are not expecting the stock to break that 3,000 mark on that counter. So those are a couple of things that I'm watching out for.
Okay, all right. So that's on the F&O space.
I understood what he said today compared to the last. It's very helpful, you know. I mean, these things are. Sometimes you just don't get the dynamics of it, but he simplified it so much for us.
Absolutely, and you're going to be able to watch this every afternoon at 12:30 p.m. before we get to our technical guest. We will be discussing F&O every day on Halftime Report with Mangalam. But let's get to Sudeep Shah, who joins in from SBI Securities on the show to discuss what he's tracking technically. Sudeep, hi, welcome to the show. Well, there's a lot of action. There's also an intraday recovery on our hands. What do you recommend?
Good afternoon, Ekta. Absolutely, there's a very good recovery that we have seen from the lower levels of the day. 17,050, 17,080 got held. And the major reason was the early morning put writing. Now, despite this gap down opening, what we have seen today, 17,100 and 17,000 put writers were quite active early in the morning. So that gave some kind of a support early on. And with Bank Nifty carrying the baton, the 38,500, 38,600 has been a very good support in the last few days. And today also that zone is guarded, and we have seen a very good recovery in Bank Nifty. So there was some call writing happening at 39,000, but that also is now reducing in Bank Nifty. We are seeing some unwinding there also at 39,000 calls, and that is giving us more confidence that this rally in Bank Nifty can continue. And going forward from a Bank Nifty standpoint, 38,900, 38,850 will act as a strong support, and Bank Nifty can inch up higher up to 39,600. From a Nifty standpoint, 17,150, 17,130 will now be a very crucial support until this holds. Upside up to 17,350, 17,360 can be witnessed. Now there is highest call writing, significant call writing happening in 17,300 calls also. So adjusting the premium now there, 17,350, 370 zone can act as a resistance. But what we feel is from the overall setup, despite the global markets being weak, a lot of macros not in favor, the kind of rebound that the markets have shown, we feel that markets are trying to make some kind of a bottom around 17,000, 17,200 zone overall from the next few days perspective.
Okay, in fact, there's quite a bit of an intraday recovery. The Bank Nifty has now moved completely into the green. It's up almost 0.2%, and a lot of stocks are gaining ground. So IDBI Bank, of course, is your big mover right now. But apart from that as well, Axis Bank is really the one batting front foot forward today. Axis Bank is now up, I think, almost about 2.5%. So Deep, just a quick word here from the financials, right, which have been big outperformers lately. What stocks would top your list?
Couple of stocks that top our list are Axis Bank and ICICI Bank. Now, first, Axis Bank, we've seen this stock taking lead in the recovery today, right from the first tick. So if we just see weekly and daily charts, the weekly charts have been forming a higher bottom, and it's trading above its key moving averages now. So it also had a resistance placed around 755, 760, and the moment we started trading, the stock started trading above that zone, it is now inching up higher, and we feel with the current structure on charts, this stock can inch up higher up to 800, 810, where it has a overhang, big resistance placed over there. So at least that zone can be retested on the upside, and for that we feel that stop loss of 755 will be a decent stop loss to put. In case the stock, in case we see some kind of a fall from Bank Nifty, but 755 will be a decent stop loss. Now, the second stock that we like is ICICI Bank. Now, it had been a leader of the entire up move in Bank Nifty from June to September and witnessed some kind of a profit booking till 830, 840 zone. Once again, it has crossed that it's to a 20 DM at 870 today, and which is a sign of a resumption of the overall uptrend. So now, with this kind of a trend reversal that we are seeing in ICICI Bank, we feel that this stock can hold 865, 870 zone. It can move up higher up to 910, 920, which will help Bank Nifty to scale up higher levels up to 39,600.
All right. Thanks a lot for joining in and giving us your picks and your view on the market itself, Sudeep. With that, we'll step into a short break and come back. We talk about another clutch of stocks which are actually buzzing around. It's the defense stocks, and in particular, the defense shipyard stocks, which are up and about in trade today. Welcome back. Let's talk about some unusual movers in today's trading session. I call them unusual because in an otherwise weak market for the broader markets, we're seeing these stocks surge, and how. Garden Reach Shipbuilders, for instance, up almost 12% odd. Mazagon Dock up 6%, and Cochin Shipyard up 4% as well. And today is not the only day they're moving. In fact, this month itself, if you take a look at it, these stocks are up anywhere between 25 to 35 odd percent. And why just today? Extend that time to this year, 2022. Mazgaon Dock has actually rallied almost 140 odd percent. Garden Reach has doubled, and Cochin Shipyard too has rallied over 50 odd percent. Why is that? Because the big opportunity that everyone's talking about in the defense sector in India itself. A lot of the defense companies have done well. 9 lakh crore is the size of the opportunity that the street is expecting this time around from the government over the next few years in the defense sector itself, as per an Elara report. And the biggest trigger will come from the indigenization share, or more coming in from Indian players itself. Currently, Navy accounts for 61% of indigenization. 39% is still left to be indigenized. And in that itself, the defense shipyard business is something which is a $60 billion or 4.5 lakh crore opportunity. Why is that? Because the Indian Navy will scale the ships from almost 137 to 200 by 2027, and that 4.5 lakh crore opportunity would be spread across submarines, which are 2.5 lakh odd crores, aircraft carriers, which are around 45,000. We had INS Vikrant launched at Cochin Shipyard recently as well, Coast Guards. And when you have so many ships, you will have ship repairs as well, and that would be a near 18,000 crore opportunity. So for this size of an opportunity, what are these stocks trading at? Well, anywhere between 10 to 15 times FY24 earnings. The only risk is the risk of execution and no orders coming in from the government. But if these companies can go ahead and promise on what the potential is, that explains why these guys are moving so much.
Okay, thanks a lot, Mangalam, for that. So that's a big move that you're seeing in the defense space. By the way, for the market as well, Bank Nifty is in the green. Nifty is also just about 50 points away from that green terrain. So we've definitely come off our lows in a big way. Look at that intraday recovery. We'll slip into a quick break. On the other side, we'll continue to talk about the markets. So stay tuned in.
Welcome back. Well, Axis Bank seems to be tearing away at this point in time. That stock is up around 2 odd percent. Just want to point out Poly Medicure as well. It's not doing much in today's trading session, but we had an interesting conversation with the management where they did say net they would be impacted positively with the rupee depreciation. Also, they are manufacturing dialysis machines indigenously, so that is a positive. They've already they've already sold around 140 or placed 140 dialysis machines, and they are looking to do at least 500 more in the next 1 to 2 years. So that would be something that I think the street would watch out quite closely. But overall for the markets, yes, there is an intraday recovery. There are around 12 stocks in the green in the Nifty as compared to around 3 stocks in the Nifty which were in the green at around 10:30 a.m. So that puts it into perspective in terms of the recovery that we've seen. Time for a break. On the other side, Manisha Gupta joins in with Rahul Sharma, who's the Director, India at International Zinc Association. Stay tuned for that conversation.
Welcome back. Joining us on the show now is Rahul Sharma. He's Director India at International Zinc Association. Rahul, hi. Good to have you as always. You know, there are 2 or 3 themes that are working in the market. One is macro, and that really seems to be shadowing all fundamentals like supply and demand. And on the other side, there are supply concerns. But because there is absolutely no demand, we really are looking at very choppy prices right now. So even as there is an information that Glencore perhaps is looking to, curtail production at the Nordenham plant in Germany, we haven't seen the prices react as much.
Yeah, good afternoon, Manisha. I will attribute it to a mix of higher energy prices in Europe, which is forcing European smelters to cut output of refined metal and depleting exchange inventories, which is generating time spread tightness on both the London Metal Exchange and Shanghai Metal Exchange. So being a global commodity, geopolitical situations play a key role in maintaining a smooth demand and supply for zinc. So while zinc markets after pandemic have strongly rebounded back, also you have recently heard that many prominent zinc producers in Europe have reduced their smelter output, be it Glencore or be it Nystar. Then moreover, warehouses stocks at London Metal Exchange and SME are at all-time low, which have in turn, set bullish outlook for zinc. with the closure of this, or reduced output of the Glencore smelter, probably you will see impact on the supply side in due course of time. Yeah, Manish.
Yeah, so absolutely, Rahul. So when you look at the supply side, that continues to see a decline. As you mentioned, the inventories on Shanghai LME have been falling. There also was a report, I remember last time that you mentioned that the International Lead and Zinc Study Group also has said that Jan to July, we've seen 2.5% of a decline in global refined output as well when it comes to zinc. Prices have seen a high this year, but with the kind of correction that we are seeing, would you say that the prices are not reacting to many of these supply side situations?
Well, presently there is a state of equilibrium on demand and supply side.
Okay.
But again, high energy cost is mounting pressure on supply side, and due to this, prices are rising. But as you know that China is the biggest consumer of zinc in the world, and demand is mostly governed by Chinese consumption. Perhaps the greatest drag on the Chinese economy comes from the property sector, which has seen the nascent recovery from last year's downturn, effectively reversed by this year's lockdown.
Okay.
So we are already seeing a gradual pickup in demand in China and other developing economies like India. So in terms of zinc supply so far this year, power costs have been top of mind for market participants. Then there are bad news coming from Star, Glencore. So they are planning to cut production at its European operations. Then moreover, mining giant, Glencore has said that they are adjusting production to reduce exposure to peak power pricing periods during the day. So, and you rightly mentioned that International Lead Zinc Study Group, they mentioned in a report that there will be a lower output of 2.5% for the first 7 months of this year. But we are optimistic that European smelters are finding one or the other way to increase their refined metal output.
Okay.
So I think as geopolitical tensions reduce and global economic situation improves, you can definitely see an increase in supply and demand of zinc worldwide.
All right. So when you talk just demand, what is your sense on what kind of a growth or an equilibrium will we find on that one? And what's your sense on prices then?
Definitely, the China is the biggest consumer of zinc and then followed by India. So as situation becomes normal in China, there will be a massive demand coming because government of China is planning to use huge money on the infrastructure upgradation. So all the infrastructure upgradation will require huge quantity of zinc. So definitely a big amount of demand will be coming out of China, and definitely India is following the demand. Then my assumption is that, although individual economies may experience technical recessions in the coming month, global zinc demand growth will remain positive. And interestingly, one catalyst to watch is LME and Shanghai Metal Exchange stocks, which are at a level where price volatility can be high.
Okay.
So combining all the indicators and present geopolitical situation, I foresee that zinc prices should be approximately USD 3,400 to 3,500 in short term. But coming winters, that will be very interesting. There will be certainly a challenging time for European smelters.
Oh, absolutely.
And it will be interesting for all of us to watch zinc prices then.
Yes,
So
actually that is... Yes, Rahul. The winters is something that the markets are waiting for on how the energy prices and then the companies, corporate segment that use energy will really pan out on in the next 4 or 5 months. But I take your point that we still are looking at a demand growth, at least that is what you're working with, and the price is at around $3,400 to $3,500 per ton in case of zinc is what we foresee this winters. Rahul, thank you so much for joining us with that detailed explanation on what to expect from the metals market. With that, it's a wrap on Halftime Report. Business Lunch will take all the action forward.